Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Commodities and bond alternatives, they're the big story in the global economy and in the ETF world. And we're going to have two experts on today to guide you through them. Sal Gilberti is CEO of Teucrium. Teucrium, very big in the commodity space, ETFs for corn, wheat, soybeans, and sugar. They have also received approval for a Bitcoin futures ETF. Yes, that one. So we'll catch up on the latest for a possible spot Bitcoin ETF as well. And Brian Lake is head of America's ETF distribution for JP Morgan, which has many ETFs for those interested in bonds and bond alternatives, as well as low volatility in equities. We'll get into all of that. But Sal, I want to start with you. I want to talk commodities. Your corn and wheat ETFs, they've seen huge inflows in the past few months. Explain to us how they work. I always want to review these futures ETFs, these commodity ETFs. They have futures contracts. They have different expiration dates, correct? Just walk us through this.
That's right. When money comes into the fund, we buy 3 different futures contracts in each fund. We never buy spot. We're always letting people participate what they call along the curve of futures. So essentially, if you think the price of the commodity will go up, you buy the fund and those futures contracts go up. The fund does what those futures contracts do, up or down, and it allows you to participate in that price movement by trading the ETF.
Okay, so you have made the point, Sal, that Ukraine is a very important source of supply for corn, and this is a critical moment for the global corn harvest. Your corn ETF just hit a 7-year high. Why is this a critical moment for corn?
It's critical because it's corn planting season in the northern hemisphere, and Ukraine, which is a major exporter of corn, the planting is interrupted, obviously. So what we've got are 2 things. Ukrainian farmers, we don't know how much corn they can plant, and if that corn isn't planted, it won't exist at all. And they're a major exporter of corn. They're about between 14 and 16% of global corn exports come out of Ukraine. If they don't plant it, they won't have it to export. That could be a big issue. And we've got corn growing and about to be harvested in Brazil in the southern hemisphere, and we'll see how that goes because that's what can replace it right now. U.S. and Ukrainian farmers are just now starting to plant.
And you've also made a very good point to me that Russia is the largest exporter of fertilizer in the world. And if you have less fertilizer out there, well, you have a lower yield on corn here. Let me just ask you one other point you made here. Russia is the world's largest exporter of fertilizer. I mentioned that as well. I want to talk a little bit about what's going on with wheat right now. And I think what's very important here about wheat here is the Ukraine is an important source of that as well. This gets harvested in June. Wheat gets harvested. What's the outlook right now for that?
Well, the outlook is, again, you're right. The wheat is planted in the autumn. It grows now. It wakes up after winter and it grows. It should be fertilized now, so that fertilizer disruptions could have a problem, could have a problematic effect on the growth of wheat in the Ukraine. But the wheat is there. It's growing. Will they be able to harvest it? That's the big question. Harvest season is late June and July. If they can't harvest it, they can't export it. Could be an issue. Ukrainian government is saying about 50% of their wheat exports may be inhibited or lost completely. And that's a bigger problem for the world as we move forward here, because those inventories being trapped are going to cause the supply disruptions for global wheat.
Brian, I know you don't run the commodities desk for JP Morgan, but they have an enormous commodities division as well here. Can you summarize what JP Morgan or your thinking is on commodities?
Yeah, well, and I'd add a little bit different angle to what Sal has talked about. So if we think about the ETF space, $7 trillion of assets invested there, and actually overall commodity ETFs have seen outsized inflows year to date to the tune of about $20 billion. What I'm seeing there is that's investors that are preparing their portfolio for an inflationary environment. Commodities can participate positively in an inflationary environment, so that's what investors are doing.
Yeah, I think that's an important point. So now, Sal, let's just talk about the sort of broad picture story here. What effect has this war and COVID had on the global commodity market? So, you know, we always talk about globalization, and it's been a very real phenomenon for commodities, too. Commodities have benefited from globalization. What does less globalization, for example, mean for commodities right now?
I think things get hurt because all the global supply chains have been disrupted, and not just the specifics of wheat and corn exports out of Russia and Ukraine. It's more, no one can count on their supplies anymore. And so people got used to operating just in time. If you used, 10,000 tons of copper a month, you knew it would come every 30 days and you didn't have any excess inventory. I think that model is disrupted now across all commodities. And so people are going to hoard. They're going to have to at least accumulate inventories to build in anticipated supply disruptions, which means the demand for commodities is actually a little bit higher, not for the actual use, but because people can't count on steady supplies. So they need to buy what they need this month, plus buy what they need to store in case they don't get their shipments next month. So I think the global disruption of supply chains is probably the biggest ripple effect out here from the war.
Okay, so the bad news is we've got commodity inflation, and it's going to be longer lived because of hoarding. But what about the other side of that? It could higher prices spur more innovation, for example. I mean, why wouldn't that happen?
It will. It just takes time. I think that, the old adage that higher prices get rid of high prices is true because, in the case of farmers, everyone will plant. It takes one season for every farmer to plant and get more crops if they're able to plant. It takes a long time to drill an oil well and even longer time to build a mine. And so the longer prices stay high, the more motivated people are to produce, the more innovation comes. Things will be invented, ways to produce that we don't even know yet. And that will happen. So over time, what the good that can come out of this is that it will spur innovation. It will spur more production. It's hard to believe now, but there'll be more of each and every commodity we're talking about than there ever was before a few years from now.
What, do you buy on? That makes sense, what he's saying to me. An agricultural revolution happened 50 years ago. Why couldn't we have another, leg up in the agricultural revolution?
I totally agree, but I think there's going to be a lag in time between when that can come online and what we're dealing with today. And that's going to take a little bit of time to figure out.
I want to talk to you, Brian, a little bit about the other hot topic, which was the big hot topic at the ETF conference recently, and that's bond alternatives and maybe low volatility equities. That's a hot space. You've seen significant inflows into some big bond ETFs. Your ultra short income ETF, the symbol is JPST, that's had big inflows recently, as is everybody else. What is that, and why is that? Why are people flocking to that as a bond alternative? JPST is the symbol.
Here's the challenge, Bob. Investors know that the Fed has indicated that they're going to raise rates. In a rising rate environment, that's going to hurt your bond investments because of the old teeter-totter, right? So investors are looking for alternative ways to get that income into their portfolio. And so JPST is a great example. It's an ultra-short ETF with a duration of less than a year. Investors are really using that as a risk-off, a step out of cash within their portfolio, but still achieving some yield. It's now north of 1%, which we haven't seen yields like that in a long time, right? Remember, it wasn't too long ago there was $17 trillion in bonds with negative yields, and now we've only got about $3 trillion with negative yields. So we're seeing that. The other thing we're talking about now is, and we talked about it with commodities, outsized flows into the commodity space, also outsized flows into the covered call space. So we've got an ETF, JEPI. This is an equity portfolio, but using covered calls, some options, we can generate income above and beyond that. Because even though we have inflation...
And this JEPI intrigues me because this is the low volatility story, right?
Correct.
So that's been a big winner this year. Stocks that have lower volatility doing better, generally, a lot of consumer names, for example. You've also seen significant inflows into that JEPI you mentioned. That's the equity premium income
so
ETF. This seeks to provide similar returns to the S&P 500 with lower volatility, and you get a monthly income, right? So you're selling calls here, right? Now, how does this work? This gets my head spinning. Trying to explain to people. It's essentially you're getting a little extra income because you're selling calls.
It's pretty straightforward, and this is a strategy that's been around for decades, right? So a basket of equities and then writing covered calls on those equities. So the S&P is down 13% year to date. JEPI, our covered call strategy, is only down 5%. So there's your low volatility story. But at the same time, we're targeting a 6 to 9% distributable yield because of that extra premium that's coming through on those covered calls. But we've actually been able to achieve quite a bit higher than that, given the volatility that's coming through the markets these days. And so that premium is a little bit higher. We've been able to achieve in some instances above 10%.
So the objective here is same return as the S&P 500 index with lower volatility combined with monthly income, essentially. That's what you're doing.
Yeah. I don't want this to sound too perfect. I mean, you are giving up some of the upside when you're getting those options, right? But the idea is you can have some protection to the downside. You're not going to take all of that downside capture as shown year to date, with the S&P being down 13, us only down 5. But then it also is going to get you that distributable yield. And remember, you're not taking on the duration. Importantly, you're not taking on the duration. You can still get that income, but you're not taking on the risk of duration in a rising rate environment.
Sal, I'm moving around a little bit, but I've got you here, and I got to ask you about Bitcoin. You recently received approval for a Bitcoin futures ETF, and of course, everyone still speculating endlessly that the SEC may someday approve a spot Bitcoin ETF, maybe this year, maybe not. Now, what's interesting is the SEC's approval letter to you contained a footnote which you believe clearly spells out what the Bitcoin community needs to do to get approval for that spot Bitcoin ETF. What was said in this letter to you?
The SEC clearly laid out in footnote number 46, for those who are looking at the document, where they want the crypto exchanges to mimic the other exchanges in that they have a comprehensive surveillance agreement, meaning they're watching for bad actors. The SEC is all about investor protection. They know there are bad actors out there. They want to be able to spot them. So they've clearly spelled out that if the crypto exchanges put in those surveillance agreements and then institute those comprehensive surveillance agreements with the ETF listing exchanges, they will get a crypto spot ETF. I don't think it's going to happen because I don't see why those big crypto exchanges would want to centralize when the whole industry's made up of the decentralized concept.
They've set up I mean, this is a real problem. Isn't this the problem? That this centralizes a business that's supposed to be decentralized, right? I mean, why would crypto exchanges agree to submit themselves to the regulation the SEC says they want when the purpose is to be decentralized? I don't know, it's a conundrum.
It is, and really the people who want to spot Bitcoin ETF for ease of access to ETF, they're the people that are getting shortchanged here because nobody has a motivation to centralize themselves that's in the crypto industry. So it's a conundrum. I don't see it getting solved this year or even next. We'll see what happens.
Yeah, and what's interesting, of course, I've had the people who run the Grayscale Bitcoin Trust. There have been threats from them that they may sue the SEC if they don't approve a spot Bitcoin ETF. I mean, what are the chances that would succeed? That would take years anyhow, right?
That's right. It would take years. And again, the SEC, they're not going to succumb to that kind of pressure. What they are all about is investor protection, rightfully so. They're going to stick to their guns unless you get a change in leadership who have a sea change in how they're looking at things. And right now they're looking at, they want to see crypto coins completely surveilled. And that, I don't see how that's going to happen. And the SEC, I don't see how they're going to back down from that when they're all about investor protection.
So you, I hate to make you handicap this, but it seems you're saying the chances are pretty nil, pretty small for any kind of spot Bitcoin approval this year.
I would say under current leadership because they've drawn a red line in the sand. So unless something fundamentally changes, I don't see it happening.
Anything else that you see out there that's really interesting? I mean, commodities was a space in the ETF business that kind of languished for years in the sort of the basement of the ETF ballpark. And all of a sudden, it's emerged as a major player that's out there. Anything that you see is, and you've been around for a while in the ETF space, that's going to be a major new player later this year? I mean, who would have thought, for example, Brian, we're talking about low volatility. Low volatility, nobody cared about low volatility stocks. And all of a sudden, ETFs that have low volatility and high dividends, who would have thought that combination would go anywhere? And it's a big star this year. So.
Yeah. I think we're seeing normal rotation in markets, right? And, we know what the last couple of years looked like. We had a ton of Fed printing and quantitative easing. And now I think the winds have shifted a little bit. And I think that started to happen at the beginning of the year. It certainly started to happen at the beginning of Q2. We're seeing investors take risk off. We've seen net $11 billion of outflows in equity, net 11 out of equity ETFs just this quarter. Yeah. And so I think what we're seeing is a healthy rotation in investors' portfolios because the winds have shifted.
Yeah, it just goes to show you, Sal, if you stick around long, as Brian was saying, if you stand around long enough, all of a sudden everything comes back into favor. But did you have any thoughts on the question I asked there?
I think that people are more aware of commodities and commodities like grains where they trade at their cost of production for long periods of time. I think people are going to realize once those prices get back down there, that's a time to layer them into your portfolio and just wait, because there's always a supply disruption, and people don't stop eating just because there's a supply disruption. And so I think that's one of the bigger functions. The other thing the market may look to doing is more actively managed funds in both stocks and commodities, because they're tired of a monodirectional market, either up for years or down for years. They want some returns no matter what the direction of the market is. And so I think you'll see some active management come to light in the next year.
I know what Brian feels about this. The question is whether active management can actually deliver on that promise. I don't want to go down that rabbit hole right now. I want to, maybe you and I could talk about this in the podcast. Thank you, Sal, for joining us. I very much appreciate it. That does it for this week's ETF Edge. My thanks to Sal and Brian. Now, we've asked Brian stick around and talk about this treacherous macro environment and his thoughts for active investing on the ETF Edge podcast that's coming up. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.